In this video, I'm going to talk about the difference between assets and expenses. Assets are going to be economic resources in your business, property that you own, things that will benefit your business now and into the future. So these are going to be things like checking accounts, cash, investments, prepaid expenses go in this category, accounts receivable. This is money that you expect to receive from customers in the future. So the business will benefit in the future when those payments are received. Inventory is property, products that you plan to sell and earn money from. And then property, plant, and equipment would be things like buildings, vehicles, equipment, land, things like that. And then depreciation, accumulated depreciation is actually a contra asset. I'm not going to get too in depth with depreciation in this video. That would probably be a separate video in itself, but just know that your depreciation over time is subtracted from your cost. And then you have expenses. These are costs incurred in order to operate your business. So these are typically things that you have used up or will be using up. Things like utilities, repairs and maintenance, meals, insurance, contractors, advertising, rent, just general day-to-day costs to operate your business. Now, sometimes you will have expenses that you pay in advance. That is technically a prepaid expense, which is technically an asset. You would put it in a prepaid expense account and then transfer it over to expense once you used it up. If you're using cash basis accounting, you're probably not doing that. But if you are using accrual accounting, you will want to think about putting things in a prepaid expense account first. And then another thing I want to mention is office supplies. If you are an accounting student or you've taken a college accounting class or high school accounting class, you probably learned that office supplies were an asset. And then at the end of the period, you counted the supplies and made an adjustment for what you used up. That is accrual-based accounting. If you're using cash basis accounting, you're probably just expensing your office supplies immediately. So I just wanted to point that out because sometimes there can be differences between what you might learn in a textbook environment versus what you might learn in actual day-to-day accounting in working in a business. Let's look at the reports real quick so we can just get an idea of the difference of assets versus expenses on the financial statements. A profit and loss is going to show me income minus expenses equals profit. So your assets are not going to show up on your profit and loss. And then I'm going to go to the balance sheet. This is going to show assets, but expenses are not part of this financial report. So assets and expenses show up on two different financial statements. So you really want to make sure you're putting things in the right place. You don't want to put expenses as assets and then it shows up on the balance sheet instead of the profit and loss. And then I do want to mention one more thing. If you're in the United States, you're probably affected by the IRS. And I just want to mention this de minimis safe harbor election. This election talks about recording assets as expenses if they are under $2,500. And there are different rules in different situations, so I'm going to link this in the description, and I encourage you to also ask your tax preparer about this so that you know whether you're supposed to follow this or not, and whether it's going to be $2,500 or $5,000. I encourage you to talk to your tax preparer about this and just double check with them on whether you're supposed to apply this. But basically what it says is if you purchase tangible, real, or personal property, tangible meaning it's something physical, it's something you can move. If that item is under $2,500 instead of putting it on your books as an asset, you would put it on your books as an expense. So this would affect purchases of things like office furniture, equipment like computers, fax machines, printers, things like that. If they are under $2,500 and you are following this election, you would record it as an expense instead of an asset. And this is per item. So if you buy 5 computers for $600 each, that is a total of $3,000. But since each individual computer is less than $2,500, then you would expense it. And this just saves you having to record things as an asset and then calculate depreciation for several small purchases. And I just wanted to mention this, prior to 2016, the amount was $500, but it is now $2,500. So this is just something to keep in mind if you are purchasing small equipment and small furniture. If you have any questions, let me know in the comments, and thank you for watching.